What is QBI and who does it apply for?
Next.
Yeah. You want to start us off?
So QBI was one of the ones that was introduced with the TCJA. At its core, the easiest explanation is it's a 20% deduction on your business profits, essentially. There are limitations involved in that. It doesn't apply to absolutely everybody. There's a special thing. It's called specified trader business. But at its core, that's where it starts. You then build the, okay, here's what it is. Can I get it? Yes, no, yes, no, yes, no, no. Okay, great. But I'll start there.
Yeah. So a couple things. Charlie mentioned the TCJA. We've got to carefully use acronyms.
True.
In the tax world. The government loves their acronyms, right? So we end up using them a lot. But
We used it a couple of times in this podcast, but fair.
Yeah,
fair.
for sure. But the Tax Cuts and Jobs Act that was passed in 2017 is the most recent tax reform. And so the Tax Cuts and Jobs Act included QBI. Now we say QBI, what it really means is qualified business income. It's a QBI deduction, so qualified business income deduction. So we colloquially refer to it as QBI. The one thing that I will say about QBI is it is the best kind of deduction. So let's operate under a hypothetical for a moment that you own a business and that business is profitable. But you come to someone like me and you say, Kevin, I want to pay less tax. Okay, in order to pay less tax, you generally have to show less profit. Generally speaking, the two are directly related.
Right.
And so the question becomes, what can we depreciate more? What can you buy this year that you weren't planning on buying this year, but maybe you were planning on buying it next year, but we deliberately put it in this year so that you pay less tax this year. Those types of things. And those strategies are innumerable and complex. But generally, the question is, how can we reduce your profit? The QBI is a deduction that varies depending on your profit. The more your profit, the higher your QBI deduction. So it's the best kind of write-off, right? It's the best kind of deduction. If you are hugely profitable, you get a really large qualified business income deduction. And so it's not an expense that you're actually incurring. It's because you are more profitable.
Right.
Therefore, you get the larger deduction. The idea is when corporations have more money and pay less taxes, they have more money to hire more people.
Right.
And so, there again, we've had this conversation in the last couple of podcasts, but that the economic intent behind the Tax Cuts and Jobs Act. So, QBI, super complicated. Charlie, it's a great explanation, which is essentially it's 20% of your profit. It's far more complex than that.
Right.
But essentially, it is 20% of your business profit. So if your profit is zero, your QBI is zero.
Zero, right. So where it starts coming into the limitations, we're not going to go deep into it, but if you're in the high hundreds of thousands of dollars of income, good problem to have. You need to work with your tax advisor as far as where the QBI comes in for you, whether it can or can't apply. If you're not in the high hundreds of thousands of dollars of income, generally speaking, you should see the QBI pull through in your tax return, and it will just be there with how that goes. Your self-employed contract on a business, it's all essentially the same when it comes to the taxes and that deduction that will apply.